How's it going, everyone? Today we have Matt, or Sniper, with us, and he is going to be talking about internal and external range liquidity, as well as time frame alignment. Matt, if you want to give a quick self-introduction, and then we will get going.
Yeah, of course. So what's going on, everybody? My name's Matt, or AKA Sniper, and in today's little interview, I'm going to be discussing my view on how I read price, which is through external and internal range liquidity and premium and discount, and also utilizing time frame alignment. But a little bit about myself: I've been trading for roughly about 4 years now. Started off doing retail concepts and obviously struggled in regards to seeking profitability in regards to those ideologies. And then I came across ICT roughly in about 2020. And ever since, I've deep dove into his concepts and his teachings. It has been definitely the more successful route into consistency and building my entry model and finding the profitability that I have been seeking for quite some time. But I'm looking forward to telling you little guys about myself and how I watch and monitor the markets. All right, so just starting off, some disclosure, and I would love to just give a quick shout out. Everything that I have learned in regards to price into the market, it's all through ICT, but also I had the pleasure of being mentored by the MMXM trader on Twitter, and this is just how he guided me to understanding price through a more in-depth standpoint. But this is a very simplistic view, and it has helped me tremendously in regards to building my bias through either weekly, daily, and also identifying my draw and liquidity. But what I'll be discussing is the definition and explanation of external and internal range liquidity. Now, just to start off and understand, external range liquidity is just old highs and lows, and internal range liquidity is fair value gaps. And the market and price only does these two things. It draws to old highs and lows, and it rebalances an imbalance. And this is just retrospect to order flow of the market. And the flow of the market is that if internal range liquidity is tagged, that is an indication for price to then draw to external range liquidity. And vice versa, if internal range liquidity is taken, that is an indication that price will draw to internal range. Now, all you need to do is use this understanding of price on the monthly, the weekly, the daily, and the 4 hour, and that's going to be your key to finding your daily bias. When you know the relationship between these two things, that is what will lead you to a high probability bias. And what I'm going to do now is I'm going to explain time frame alignment in regards to the external and the internal range liquidity. So what you want to do is when you're starting off and you're trying to generate your bias, whether it's weekly or daily, you want to look for market structure shifts off of higher time frame key levels. And a higher time frame key level would be your external or your internal range liquidity. So say price drops into a monthly bullish, let's say fair value gap. You would like to drop and watch the reaction after that monthly key level is tagged on a daily chart. And then you're going to look for a market structure shift off of that monthly key level on the daily. And that will trigger a buy or a sell program in regards to what order flow is looking like. And the same thing vice versa, weekly chart, watch a 4 hour reaction off of that weekly key level, the external or the internal range. And likewise with the daily and then into the hourly, 4 hour to the M15, hourly to the M5, and M15 to the M1. And now what I'll do is I'll show you a little bit of a diagram, a model to base off price for your entry. And this will be in regards to a market maker buy model. All right, so now cutting into the diagram as to how I just listed looking for your time frame alignment and your external or your internal range liquidity pool. This is a model based off of price reaching a higher time frame external range liquidity pool. So label this as your lows. This is your sell side. And we're watching price run that on the daily, the weekly, or the monthly. And another key thing to add in here is looking for SMT divergence when price runs into these higher time frame key levels. because that will be your extra confluence booster when you're looking for that correlated time frame to identify a market structure shift. So when price reaches this daily or weekly external range liquidity pool, we're going to drop. If we're on the daily, we're going to drop to the 1 hour. If we're on the weekly, we'll drop to the 4 hour. Monthly, we'll drop to the daily. So when price pushes up and closes above a swing high, like we have labeled here, we wait for price to retrace into that either breaker block, or we could look for a fair value gap that we would anticipate for an entry possibility. And this is just another fractalized concept, because say price is closing above a 1 hour swing high off of a daily external range liquidity pool reaction. Understanding this, that price is fractal. So price running a 1 hour swing high, that swing high is external range liquidity. So what is price going to most likely do next? Price would be dropping and retracing into an internal range hourly fair value gap. And if that internal range hourly fair value gap lines up with a breaker block, that would be labeled to me as a high probability entry, especially if there was SMT at the lows when we ran that higher time frame external range liquidity pool. And then as we get the confirmation that price pushes up and moves higher, then we can label this and identify, okay, we're moving for a market maker buy model to a draw of a higher time frame internal range liquidity pool. Because again, we're looking and anticipating for price to do a higher time frame external range to draw and rebalance the internal range liquidity pool fair value gap. And that would be a daily or the weekly or the monthly draw. And what you would be looking for is the fair value gap or the internal range liquidity pool to be lying in premium of the range from swing low that took out the external to the most recent energetic swing high. And in the process and the move towards our draw on liquidity, you could use order blocks that are resting on the sell side of the curve as potential mitigation blocks to look for PD arrays to form inside of these areas in price. And these could be labeled as your accumulation, or on top of that, reaccumulation, for price to then finalize and reach its original consolidation internal range liquidity pool. But now that we see the model, I want to show you guys an example as to what happened exactly on price today. And we'll look at the NASDAQ. All right, so moving into an example, after looking at the diagram that I showed you guys, we're going to be looking at the NASDAQ on the left and the S&P on the right. And the first thing that I said in regards to what you're supposed to be looking for in price, we're looking at the hourly chart here. And the time frame that's aligned with the hourly chart is the 5 minute. So what I already noticed and identified here is that we had price take out this external range high. After we took out this external range high, price drawled into this internal range liquidity pool, this hourly bullish fair value gap. And another thing that I noticed is that we created SMT divergence inside of that hourly PD array. So what we're going to do is we're going to look for the reaction off of that hourly key level. And what you can see blatantly is price closing above this swing high after we take out these lows and reach our internal range liquidity pool. So we have a closure above the high. So I am automatically assuming that we're going to have a draw to the next external range liquidity pool, which is this hourly swing high. Or on the 5 minute, this could be labeled as our original consolidation, because we have hourly key level, then you look for an M5 market maker buy model. So once price retraces after we reach this external range high, it reaches into this 5 minute bullish fair value gap. But like I said, when I'm talking about price being fractal, price takes out this 5 minute external swing high. What does it do after that? It retraces into this 5 minute internal fair value gap. And then this could be utilized as your entry, or if you would prefer to wait For more confirmation, you could see that price closed above this last down close candle that tagged the gap, created a swing low inside of it, and then retagged the down close candle here. This would be labeled as a 5-minute bullish order block. So you have two means of entry that could be directly to your draw on liquidity to 17,591.5. It's a very simplistic view to price, and I feel like it's very overlooked, and not a lot of people utilize it or can see it properly. But all you need to do is when you're properly aligning up your time frames, wait for the shift in market structure after you get that reaction. Once you have the candles that are closing above the swing highs, after price reaches into the internal or the external range, execute your position and have your stop loss resting at the low that tagged the internal range or the external range. Put on your risk and let the trade do its thing. All you need to do is have a plan behind your trade and then trade the plan. Now I'm going to do another example. This is an example on oil. And right now I'm looking at oil from a daily perspective. So we had this clear and obvious market maker sell model on the daily chart. Price takes out this external range liquidity pool. And what does it do after that? It retraces into this internal range liquidity pool, but was able to tag premium of that last energetic swing that took out the external range liquidity. So price reaches the internal range, and then after we reach the internal range liquidity, tagging premium, we draw back into external range. So you can see that it's just the process of how the market moves. And if you look at the hourly chart, and all you would be doing from the hourly chart is just identifying and watching structure play out for your market maker sell model. And what you could see and just label off just little purges of highs, price breaking down lower. We didn't get the candle closure below here yet, but once we did get the candle closure below on this low here, price retraces into this hourly gap. This could be the potential short entry, but if you even wanted to label it for advanced market structure perspective, price reaches this swing high. So this would be labeled as a long-term high. We form a short-term high resting here. This short-term high gets violated, creating an intermediate term high, trading into this hourly bearish fair value gap. And then to the right of this intermediate term high, price creates another short-term high here, breaking down lower, closing below this low. The next short-term high could be labeled as a potential entry to short to the external range low with a stop loss resting here, or if you didn't even feel comfortable with that, you could put your stop loss a little bit higher, closer to the intermediate term high. All right, so moving on to another example, I'm looking currently at a weekly standpoint for the NASDAQ. And we're going to be looking at this draw after a reaction from our weekly internal range liquidity pool. So price reaching this internal range liquidity pool, we're obviously going to be watching and monitoring price and the reaction off of it on our 4-hour chart. So the first thing that we're going to be obviously looking for is the SMT divergence inside of our higher time frame key level. And what you can see already, this SMT resting here at these lows inside of our weekly bullish fair value gap. And as price continues to push in our anticipated draw on liquidity, what do? We have a run on this external range high after we create the SMT. And after we reach the external range, price retraces into a discounted internal range liquidity pool, resting here. Moving into our direction to our anticipated draw, we're looking at the day, which is Sunday. And as you can see on our weekly standpoint, you can see how close we are to our draw on liquidity. So there's not much more for price to do in regards to waiting for Tuesday or Wednesday to be our anticipated day for price to reach its draw. So given the fact that we tagged this internal range already and we're making our move to that external range liquidity pool, I can anticipate already that Monday will most likely be able to give us that opportunity for entry. Moving into Monday's price action and just watching how we're going to set up for the day, we're coming up into New York session. And as we get right into New York, we have a reaccumulation stage resting here. And all we need to do and understand is that this is just a consistent process from external range to internal range, taking out this external range high, retracing 4-hour bullish fair value gap, internal range liquidity pool. Now, the next time frame that you can align from the 4-hour chart is the 15-minute. So what I could do here, because it's best to always wait for indices post 9:30 open on equities, for equities open, I could watch and see if I could frame a trade off of this M15 chart. So if we draw a vertical line here, here's equities open. So I can't execute on this primarily because this is consistent to my rules prior to the equities open. So what I'm going to do is I'm going to watch the M15 chart to see if I could use an M15 PD array to reference to then drop down again to the M1 chart. So what I just did was I did weekly to 4-hour to 15-minute. Now I'm going down to the 1-minute chart. And what we do is obviously we wait for premium and discount. So in regards to our higher time frame draw, I'm looking at price to drop into discount of the range after we had our energetic move. So once price drops into discount of the swing, reaching into this 15-minute bullish fair value gap, I can watch now price reacting off of this gap. Now, we're looking at the 1-minute chart and the reaction on our 15-minute discounted fair value gap. And as you can see, using that 15-minute key level, we could frame an M1 market maker buy model based off of our reaction here. So breaking this down, after we have price reach that M15 gap, we had price close above the last down close candle that took out the liquidity. This would be our change in state of delivery here, as well as a bullish order block. And then as price continues higher, we close above this inversion gap, use it as support, and continue. And what did I say earlier in regards to mitigation blocks or up close candles on the sell side of the curve? They're used as mitigations. And you could see this up close candle, what formed inside of it. We created SMT divergence and we created a M1 bullish fair value gap that could have been used as support for higher prices. And then again here, we had an up close candle resting here. We had a bullish order block that supported price to move higher to our drawn liquidity. But exactly how I had the diagram and model shown is exactly how you want to mimic it for your time frame aligned trades. So the daily, if this was a daily fair value gap and discount, and this was an hourly, the same thing would go for if this was a weekly fair value gap and you're looking at this on a 4-hour chart. Everything is the same. It's just you should be lining up your timeframes properly when it comes to external and internal range liquidity reactions. All right, so here's another example, and this is just price running external range liquidity on our daily chart for the S&P 500. So price runs these lows, this external range low, and we create SMT divergence with the NASDAQ at these lows, just like how we had the SMT divergence inside of the weekly bullish for value gap. So what we can do now is go from our daily chart to our hourly. And what we just wait for is that proper run or closure above any sort of swing high. So after price creates the SMT on our daily chart, we had very, very energetic displacement above higher. But we do have a swing high here, even though it is very minor, it's still a closure above. And we have the higher time frame daily SMT, which is fair to watch and assume that our change in state of delivery is to higher prices. So the next thing what we look for, we can measure premium and discount from this swing high and this swing low. Price retraces, drops down into this hourly bullish for value gap resting in discount. So what I'm going to do is watch for a reaction off of this hourly bullish for value gap on the 5 minute. And we could use this high as a draw and this high as a draw. So watching this on the 5 minute chart, what do we have? We have some potential advanced market structure that we could use as a reference. So if we use this low here, label it as a long-term low, set inside of that hourly internal range liquidity pool. Price pushes up. We failed to close above that swing high, just completely fine, understandable. But we create a short-term low here that gets violated and creates an intermediate term low, resting here. After we create that intermediate term low, price pushes up and confirms a closure above a swing high. Now, every single time that you create and monitor advanced market structure off of certain reactions from higher time frame key levels, long-term low, short-term low, intermediate-term low, to the right of that intermediate-term low will be your preferred entry, short-term low, to your anticipated draw on liquidity. So, in another means of looking at this as price retracing into a 5 minute internal range liquidity pool after taking out this 5 minute external range high. And what happened when price did the same thing here? Price reached all of these external range highs, and the first thing that it did was rebalance this M5 imbalance. But then failed to close back above this and move back up and dropped back lower, just retracing into external range liquidity pools. But that was literally just another example as to watching reactions off of those higher time frame key levels and then properly aligning market structure to your draw on liquidity. And this would be the most idealistic view for your means of entry and trade management. Looking for that intermediate term low or any sort of run on stops, and then looking for that short term low to the right of it, or vice versa. If you're bearish, checking for the intermediate term high stop hunt, using the short term high to the right of it as your means of entry. All right, so framing and giving another example for a daily internal range liquidity pool to external range liquidity pool draw. So going back and forth and just piggybacking off of everything that I've said earlier, you already know what I look for. Here's an external range high. Here's price trading into an internal range liquidity pool. And you measure from this swing high to this swing low. That internal range liquidity pool is in discount. We're looking for SMT divergence inside of that higher time frame daily key level. I have the YM to my left. You could see corresponding lows as price gets into that internal range, created SMT. So I'm already having the first thing checked off, and now the second thing checked off with the SMT and the higher time frame key level. And another thing to note is that the bodies of the candle on the daily chart, we're not closing below it. The wick is just doing the damage, and the body is telling us the story. So what we move to next here is this. We drop to our hourly chart, and we see if we could frame any sort of means of entry for proper structure alignment to our draw and liquidity. So we have our hourly chart. We're labeling a latest swing high that runs the low and then breaks structure next. So this is our hourly swing high that we're paying attention to. Price doesn't break structure just yet up until we get into the end of London at 5 a.m. And now price moving into New York session AM session doesn't look like the means of opportunity were there just yet. But what price did when it got into the PM session, after we had that confirmed shift in structure, price retraces into this hourly bullish breaker block. So this would be labeled as our higher time frame key level in correspondence to our 5 minute chart. So we're going to drop and look at the reaction off of this hourly bullish breaker block. Now, looking at this from the standpoint on the futures charts, obviously it's different because on my MetaTrader, when I was looking at this live in action, this was a 5-minute tag of the breaker block, which is what I used personally when I executed on this position. But nevertheless, if you're still looking at this on both charts, whether it's the CFD or the futures, this would still be a good means of entry. But unfortunately, on the futures chart, it didn't show the actual labeled tag compared to what it did on the MetaTrader. But the reaction off of the hourly key level was bullish. Price closed above that swing high. You could even use standard deviations and measure for projected swing. And as you can see, say you executed on this breaker block, put a stop loss below here, take profit at 2 to 2.5 standard deviations. That would be a 1 to 2 or 1 to 2.5 risk to reward trade. But if you guys can properly see this and understand that this is a very simplistic process to breaking down price in regards to higher time frame bias, and then using that to align up to identifying your draw and liquidity, entries will be very, very simple. Because all you need to do is wait for those reactions off of those higher time frame key levels and execute on the correlated time frame that you're utilizing.
Well, thank you, Matt, for coming on, and I hope you guys all learned something. If you want to learn more about how Matt trades, check the link in the description below, and I will put his Twitter as well as his YouTube down there. I hope you guys have a good one. See you next time.